Hi, everybody. I'm Meredith Walker. I'm with the Texas Business Hall of Fame. Thank you so much for joining us on this call today. It's going to be a fascinating conversation. For those of you who have not participated in one of these calls, just a few housekeeping items. If you're not speaking, please have your self on mute. It creates a lot of distracting background noise. We've all experienced that. So also, the only way to ask a question on this call is through the raise hand function. But please note that some of our legends and directors have been tagged to initiate the conversation for the first half of the call to set the tone and the pace. So around 12:30, we'll start looking for hands, and I will be giving our moderator names to call on. The first 45 minutes are questions restricted purely to our directorship and our legends. The last 15 minutes are saved for our amazing alumni and Scholar Award recipients. So we look forward to that last part. That's always engaging. Before we get started, I always like to acknowledge our Hall of Fame members that are joining us. Ernie Cockrell out of Houston with Cockrell Interest, Richard Fisher out of Dallas, Senior Advisor at Barclays and former President of the Federal Reserve Bank of Dallas. Lucy Billingsley out of Dallas, co-founder of Billingsley Company. Gary Dudley out of San Antonio and the co-founder of SWBC. Woody Hunt out of El Paso, the founder of Hunt Companies. Harvey Najum out of San Antonio, founder of Sirius Solutions. Sam Sesser out of Corpus Christi, chairman of Sesser Bank Holdings, which is based in Dallas. We also have Graham Weston out of San Antonio, the founder of Western Urban and co-founder of Rackspace, and most recently Community Labs. And then we have Patricia Will out of Houston, the founder and CEO of Belmont Village. Thank you all for being on this call today. Now it is my pleasure to introduce our moderator, Curtis Burchard. He is the Executive Vice President of Commercial Real Estate at Texas Capital Bank. Curtis, I'm going to turn it over to you. Thank you so much for doing this for us today.
Thanks, Meredith. I appreciate that, the opening there. And I want to say it's great to be a part of this today. Thank you for letting us do this. John and Robert, I know y'all don't need really any introduction, but thank you both for taking time to share your views, all of your experience and insights from your respective notable real estate careers. The COVID pandemic has changed the way we live, work, travel, and interact with one another. It's evidenced by us having this Zoom call today. Its impact on commercial real estate seems to vary based on both the product type and its location. So to get started today, I think many of us, our viewers, guests on here, would appreciate hearing from each of you your perspectives or your views on the current impact of and the future status of office or hospitality or hotel, retail, every product type that we could talk about, whatever you guys want to lead in with. Would appreciate hearing your views on the impact of COVID on those types of real estate properties. So maybe I'll toss up to John or to Robert, who would like to chime in first.
Robert, you want to go or you want me to go?
You go ahead.
I'll go ahead and start. Well,
you can do the office, I think, or something.
Okay, I'll take office on first. Well, first of all, I just want to say that in my business career, I have never felt the fear that I felt going into this pandemic, and just watching the news unveil itself and the talk about this massive stimulus that occurred. It was, I can honestly say I've never been this fearful, including 9/11. Our office business, fortunately, has stayed relatively intact. I think we've collected about 98% of our rents, but keep in mind, we tend to be at the high end of office product. So we spend a lot of time underwriting the credits, and I will tell you that's paid off. In my view, the office business has a lot to do with underwriting unsecured credits, because that's really at the end of the day what you have. And we spend a lot of time on that, and it's paid off in this cycle. Now, that being said, we've we've suffered in a few spots. For example, like the West End in Dallas with all the violence and that's occurred in that part of town. You know, that new leasing is very tough to come by. But our higher end product, while leasing has been slow, we've continued to see some activity. It's very interesting. We're in the middle of developing a new building for a high-tech tenant that everyone knows. And they called us in June and said, okay, we had the building spec'd at 175 square feet per employee. We want to double that. And our question, of course, was, well, does that mean it's going to be half the people? And they said, no, same number of people, but we want double the amount of square footage dedicated per person. So the office business is clearly going to be impacted going forward. There's, I think older product is going to really suffer. New systems are absolutely going to be required, whether it's air filtration, elevators that are destination elevators, all those sorts of things. There are going to be a lot of changes to that business model. But it's, I would say, of the different real estate categories, office, because leases tend to be longer term in nature, is one of the more protected asset classes. Now let's pray for a vaccine and quick.
That's great insight. Do you think there's a difference there, just to follow on to that, John? Do you think there's a difference between urban core or suburban when you talk about, for example, height of the building? Again, maybe new suburban might fall in what you're talking about, be okay, but older product, even though it's still walk up, might not. They still got to put in air filtration, et cetera. So do you have a view of core versus suburban?
Yeah, I think we're going to see more campuses be built. I think we've been avoiding suburban, I would say, just as a generalization. But I would say now it's going to come back into vogue. The issue there is a lot of suburban product is old, dated, and has antiquated systems. So that's going to challenge that kind of product.
You know, John, I would just add to that is that you know, so much talk about working from home and what's going to happen with the office buildings and whatever. But I think it's becoming clearer and clearer by the day that people are valuing the collaboration, the teamwork, the mentorship, the socialization, and whatever. And the idea that people aren't going to come back to the office buildings, I think, is out of bounds. I thought it was interesting. Y'all may have seen that recent poll that Price Waterhouse did, where they polled the employees and the employers. And the employees, they polled 70% said that they want to be working most of the time or most of the week at the office. And it was very, very positive. And the employers, which I thought was interesting, 70% said that over the next 3 years, they would need as much or more space than they have now. So I think that was reflective of what's really going on out there. And with that being said, the only thing I would add to the office side is, you know, for those that are less fortunate than you, that have the projects that are just somewhat commoditized out there, I think it's going to be a rough road. The sublease space is mounting by the day, and it's and also, you know, as we know, the leasing oftentimes lags a recession. So I think it's going to be tough sledding for commodity product out there.
I agree.
Curtis, do you want me to, we had the benefit of your first question there of talking about the different product types, and John and I conferred, and I was the lucky one that drew the industrial component, which is kind of the belle of the ball these days. So maybe I'll tee off on that. I know that Lucy Billingsley is on this call. So Lucy, anytime let me defer. You can correct anything I have. I think you're on, Lucy. So if I veer, then straighten me out. And Ernie, and so we've got a lot of players on here that know, you know, oodles about this area. But but clearly the industrial side, Curtis, is that the e-commerce phenomenon has been really the story of the decade, and the Amazon effect. And that's literally been driving the tremendous construction and absorption of industrial space all over the world, but especially in this country. Some of the metrics are staggering. You know, as an example, in the pandemic has accelerated that. In the second quarter of 2020, the increase in online sales equaled the increase over the previous 3 years, as an example of what's gone on. Now, that's not sustainable, but it's significant. You may have read in the Wall Street Journal today that in this recent third quarter, that Walmart's online sales increased by 79%. So you're seeing these dramatic, numbers, and I'd say e-commerce is a huge driver, but also the new inventory shift from what they used to call the just-in-time inventory to real-time inventory, or redundant supply, or what have you, which means that with that time spread narrowed, they require more inventory and more space. And I'd even add that the early stages of what appears to be a trend in domestic manufacturing, more domestic manufacturing, will probably have an impact as well. As we know, developers are never lazy when it comes to meeting new demand, and so the construction, not surprisingly, the construction has been more than robust. In 2020, there'll be 440 million square feet under construction, new construction, we were beginning to see a little slowdown in new construction because of construction, the slowdown of construction loans, harder to come by. A lot of the public REITs were concerned about balance sheet considerations and earnings, and so we saw a little cutback there. But the early signs are it hasn't really cut back a lot, and even though a few things to watch is, even though the absorption has been extraordinary, the third quarter was down. The third quarter absorption, but activity levels are very high. The current vacancy nationwide, which is always tough to generalize, but it's 5.5%. So even with all this construction, you'd certainly call that healthy. Unlike, and I would say of all the food groups we'll be talking about, the only food group where we've had a rental rate increase in 2020 has been industrial, with a very slight increase in the rental rates. When you look at the capital markets to kind of complete the picture, once again, industrial is the only food group where we've not had declining transaction volume. And it's only been flat during this time period. Caveat there is that since April, there was a lot of carryover into the first quarter of 2020. So when you look at since April, there's been a pretty significant decline in transaction volume, but the pricing has been stable, and even, for high quality product and investment grade tenants, you've actually had cap rates decline slightly, even during this time frame. So overall, I would say industrial, very favorable.
Which is really encouraging, right? I mean, it's what you describe as the e-commerce. It's good news to see that market be as healthy as it is, and the square footage numbers. I'm a numbers guy. I like hearing 5% vacancy nationally. We see lots of things regionally that are essentially full, right? Effectively full. So I really appreciate your insights there. Do you guys want to take more? I mean, I've got a whole list of property types we can cover if you guys want to keep going, or we can open it up. I don't know how much you want to by type, if you want to talk about hospitality, or you want to talk about multifamily, or you want to talk about anything else, or you guys want to open it up to questions. I'll leave that to y'all.
Why don't we, I would suggest we open it up, and if those are part of the questions, that'd be great.
Perfect. Meredith?
I'm here. I think our first question is from Richard Fisher. Richard, do you have a question?
Yeah, well, first on Robert's point, as much or more. Just, I'll give you one example. We have 39 million square feet of office space on AT&T. I'm on their board. It's kind of interesting because we've been surveying employees. They're much more conscious now of the non-pandemic health concerns, cold and flu, and working in dense spaces. So it's not a matter of getting rid of that 39 million square feet. It's a matter of using it to space out to make up for those who we feel will not need to come back and can work remotely, either full-time or part-time. So I think that goes to Robert's point. My question is for John, who is one of, I think, I'm sure Robert's one of the great people on the planet, but John is really one of the great people on the planet. John, on occasion, am asked to advise Barry Sternlicht just on what's going on in the macroeconomy and so on. A couple of weeks ago, our last conversation, he was talking about the hospitality space. As you know, Starwood's big in that area. And he's finding things to buy. The nice thing is these prices are suppressed. He has plenty of cash. And looking for yield properties of interest, and I don't know if either of you want to address this, they're particularly finding low prices relative to yield and underlying value in Europe right now. And the point is this a great opportunity to go into the hospitality space, assuming it's the right property? Or does one just go into a defensive crouch here?
Well, like Barry, who's a good friend, and I've been partners with Barry before, we're actually buying hospitality. We went into this downturn with a fair amount of hospitality. I think we have 14 hotels in our various funds. And then I own personally Canyon Ranch. And, you know, of all my worries, those were my biggest set of worries, the impact on hospitality. And we got clobbered. We had to shut down virtually, well, in every single case, we had to shut down. It's coming back. It's coming back slow. And let me just make a comparison to kind of touch on retail for a second. Retail I've always avoided because I've never gotten my head around the concept risk of retail. And we're so over-retailed in this country. We've got 5 times the amount of retail per capita in the US of what's in Europe. Hospitality, we've had good fortune in. And I think unlike retail is going to have a permanent valuation diminution. And some of it's just going to have to go away. Hospitality will be back. Is it going to be back exactly the same? Is it going to be smooth across all hospitality flavors, you know, whether it's limited service? I don't know that I'm smart enough to assess that, but we have bought our first new hotel in the pandemic. It's a relatively new product. It's in a great market. It's actually performing okay. And okay right now is kind of 50, 60%. That's okay. And so we bought it on those metrics. And I think there'll be a lot of upside as we recover, because we're going to recover. Our hospitality located in destination properties, Canyon Ranch, we have properties on the beach in Florida. Properties like that have come back faster. And slowly but surely, urban products coming back. But until we start flying in great numbers and we have business travel in great numbers, that product's going to continue to be tough. But I think it's a temporary diminution in value. So to get to your question, we don't invest in Europe. My problem with Europe has always been the labor force issues that you have to deal with and tax issues. And I feel like we have enough opportunity right here in the US. That's not to say I wouldn't, but we stay with what we really know. And that's been the U.S.
Thank you, John.
Thank you. Good to see you.
See you.
Thanks, John. Thanks, Richard, for your question. Next board member we've got Lucy Billingsley. Are you there, Lucy?
Here. I am here. Thank you. This is a treat. John, I'd appreciate it if you just stay out of suburbia. Keep your offices in all those urban locations.
You've got some great locations.
Well, not enough.
They'll do well.
Not enough. I have a couple of questions, and maybe I'll just, well, they're very different. So let me just toss out the first one. Let's talk for just a second about the CBD. How long do you think this movement to suburbia really will be there? I think it impacts not only downtowns, but even high density zoning. So is your sense that once we get the vaccine and off we go, that these issues fade behind us? Or do you think there's some permanent changes in location decisions and density? Then I have one other follow-up.
Robert, you want to take that, or you want me to take it, Lucy? I'll hit it real quick. I think on the margin, there is some permanent change, but I think it's on the margin. You know, if you go, we went back, and I've spent a lot of time studying other pandemics and the impact it's had on, you know, economies, whether here or abroad. And it's surprisingly how fast the world or a population gets through those and comes back and doesn't have long-term memory of it. I mean, they remember it, probably impacts their behavior, but it seems to be on the margin and not really systemic. So that would be my comment. But I do think, and I really do mean it, you know, the locations you have, suburban locations, are going to be phenomenal. And so, you know, land is a wonderful thing to be focused on right now as a real estate investor.
So actually, I have two more quick questions. Thank you for that. Malls, how are they going to be repurposed? Not the ones that continue to exist. Are they going to be torn down? Are we going to be going for new zoning, or are they being repurposed? There are a lot of them.
There are a lot. There are too many. Well, Robert, I don't want to dominate, so you just step in and interrupt me.
I'll jump in, please.
Okay. On the mall issue, I actually, believe it or not, I'm a terrible short. You know, I do two things. I run a family office and I run the retail, or not retail, but real estate business. And on the family office side, we went into the pandemic short the bonds of some of the mall owners. I've never been a big investor in retail at all, as I said. We're definitely over-malled, and malls are going to have to go through a massive change. There are going to be those like North Park that are going to continue to thrive and succeed, but they're going to be, you know, relatively fewer in number than the number of malls we have. So I think they're going to get repurposed as schools, as wellness facilities, some type of healthcare, perhaps enterprise zones where you have accelerators. I mean, we're talking about that as part of my job, where the mayor's appointed me head of the task force to get us out of the pandemic in Fort Worth. You know, we're looking at repurposing certain assets within the city to try to grow businesses. So I think there's going to be a variety of uses for malls, but I think you've got to really dig down deep and look at what is the land value.
You know, Lucy, the only thing I would add to that, I think you're both right on when you're talking about the repurposing. When you look at the locations and you look at most of the malls in the country, I think it's pretty foregone conclusion that they won't just bounce back, or we won't see bricks and mortar retail bouncing back. So they're going to have to be repurposed. But Many of the locations are, as John points out, many of the locations are excellent locations. So I think we're already seeing some of these. I think part of the problem has been the valuations have had to come down and are still having to come down for some of those repurposing, but we're already seeing some of them being evaluated and repurposed as industrial parks. So I think you'll see some of that and in some of the other, but I agree that it's very tough sledding for their original design.
So my one last question, I apologize for being so overbearing, but I heard predicted this morning that within the next decade, a major data-driven company, let's just say Google, would come and buy a major brokerage firm in real estate. Robert, how wild is that? I mean, or how fabulous a payday?
Well, yeah, but you know what's interesting? Like, are you talking about them buying sort of like a services company or a full service type company? Or are you talking about
major brokerage
development? Okay, brokerage. Okay. Yeah. Well, you know, it's pretty amazing. You know, we've seen. I mean, gosh, you saw some of the private equity companies come in and make a play in the service company side and so forth, but. All I can say is, from our experience, it certainly isn't a business you want to have any debt on, and it's certainly a business that is very cyclical. So, so good luck.
Thanks.
I think, Lucy, what I would say is that that's not a crazy concept, because real estate is a data-driven business now like never before. You know, if you go all the way back to the 80s, there was hardly any data that really existed, and what existed was not all that reliable. And in the 90s, it got better. And once Wall Street interfaced with real estate, which many people said would never happen in a big way, but it happened in a huge way, both through REITs and CMBS, all of a sudden data became critically important. So the bulk of that data emanates from large brokerage firms, and Google's a data-driven business. So does that make sense? It actually does. And I know nothing, but I'm just saying, I think it's not a crazy concept.
Thanks.
Great questions, Lucy, and delighted to listen into this conversation. This is terrific for me. I think we've got a next question maybe from Sam Susser. Sam, are you with us? Can you chime in?
Yes. Good afternoon. John, Robert, thank you so much for sharing your wisdom and time with us today. We're in the midst, I think we all believe, in a change in presidential administrations, and would love to hear your reflections or thoughts as to what policy changes might be coming that would have an impact on the real estate industry or in the capital providers to the real estate industry. What are you worried about? What are you hopeful for? Thank you.
Well, I might take a stab and then John jump in. I think you know, clearly there's been concern out there regarding a change from in the the approach to redistribution of wealth, and what that in the tax picture that could have a serious impact on real estate. I think also, however, I think there's a feeling that we'll perhaps see a quicker and perhaps larger government stimulus, which both Wall Street and I guess most of the business world welcomes. So I think the you know, some of the concerns that I would have and that I hear are have a lot to do with the concern for increased regulation, and I think that how that plays out is going to be something we'll be needing to watch. John, what are your?
Yeah, Robert, I think, I mean, you've hit on it well, but I want to stress something because the one thing that drives my bullishness on real estate more than any other piece of data is population growth. And, you know, we look at a lot of gauges in our office. We consume a lot of data. And the one thing we really follow is population growth. So over the next 10 years, we're going to add, even though population growth is way down, we're going to add through immigration and net growth of the existing population, 20 million people. So 20 million people is like adding all of New York City, LA, Chicago, Phoenix, and Houston over the next 10 years. So the question is, where are those people going to be? And that is going to be guided by politics. And we follow that more than anything. And so the in-migration within the US and where things need to be built to house and provide healthcare and education and all the various things for these people, offices, where's that going to be? And I got to tell you, you know, we're sitting in Texas with this giant catcher's mitt. And that's where we're going to be the recipient, along with other states, of a lot of immigration. And obviously we're seeing it. So there's this migration out of anti-business, high tax, high regulation, lockdown states to those that are much more business friendly and that have their act in order. I had 2 meetings last week with very significant companies that are relocating, one out of San Francisco, one out of LA, into Dallas. And these are major companies and none of this has been announced on either. They're just 2 individuals I know. And so I'm trying to help them. But they're out of there. And they said, we're not going back. And it's amazing the amount of energy and resources they're putting into court all of those employees to relocate, all of them. And they're getting a pretty good hit rate. So these are great jobs that are coming right into the house. So one last thing, this because I think it's kind of interesting. One of the data sources I look at, which sounds a little silly, but it's interesting, is I look at budget rental trucks in U-Haul. And if you look at U-Haul, LA to Phoenix, I looked at this last night, it's, call it $2,000 per truck. If you want to go Phoenix to LA, it's less than $200. If you want to go San Francisco to Houston, it's like $4,500. If you want to go Houston to San Francisco, it's less than $100 per truck, because there are no trucks left in California. They're all scattered around Colorado, Florida, Texas, and Arizona, and Nevada. So this is a profound change that's only being amplified by politics, and I would argue bad politics, and it's going to have a profound effect on our industry and on our state.
Thank you.
Lucy, I might just, as it dawns on me when you mentioned the different locations and in-migration and whatever, reminded me, Lucy, you were talking about the asking about, hey, what do you think? Is this a mega trend from the urban to the suburban and so forth and so on? I might just add on that. My personal view would be there's a big mega trend to that we've seen for some time to the live, work, play.
And Atkin bars.
Oh, are y'all hearing? Can y'all hear me?
Can hear you now.
Okay.
Yes.
And I have to think that's a mega trend, that'll continue, that urbanization, amenitization is huge. And so you can't do that without critical mass and so forth. So I think you'll see that live, work, play. However, I have to say, I think it might depend. We're going to see it play out interestingly, because I don't think you can ignore, let's say in the multifamily area, that not just pandemic driven, but over the last decade, you've had the suburban markets outperform the urban markets in both rental growth and occupancy. And I think the pandemic has probably accelerated that some. And from what I can tell, when you look, a huge foundational issue that we have is the undersupply of housing, and the fact that a lot of what's been built has been the high-end infill urban higher rent apartments. The average apartment the new apartment that comes online today is over the price range of 70% of the population. 70% can't afford it, of the renters. And so I think you will be seeing a significant movement to the suburbs, and even to secondary and even tertiary cities. And there's going to have to be some solution to workforce housing, because that is going to be a real serious issue, and it tends to want to drive a mega trend away from the more expensive urban locations. But I just mentioned that because you asked a great question there.
It's a great thought about affordability, right? I mean, that's very insightful. Appreciate that. Thanks, Robert.
Curtis, we have about 6 minutes left before we turn to our alums. So I'm hoping we can squeeze in 2 more questions if possible. Just
okay. We want to try Jack Spector with Hickson. Jack, are you with us?
Yeah. Yes, I'm here. Thank you, guys. Thank you, Robert and John, both of you, for attending. You both touched on a few things that raises questions in my mind, especially the last bit of dialogue about the mega trend of urbanization, but significant moves to suburban and even secondary and tertiary cities, and some cities that I'm familiar with, smaller cities that have great quality of life, that happen to be near very dense urban populations. I'm particularly familiar with a city, Bend, Oregon, that has a great quality of life. And the real estate prices have gone crazy from people from Seattle, Portland, LA, San Francisco. You can work remotely there. And it doesn't take much of a out-migration or immigration from these large cities to make a huge impact on some of these smaller cities like a Bend. And there's many of them across the country that would have the same dynamics. Do you think there's long-term winners and losers in cities as a whole as a result of what's going on with the pandemic, and maybe layering over politics on top of it? And as a side, I was on a Zoom yesterday with about 30 young people all over the country, large cities, New York, San Francisco, LA, and they are one after another saying they're seeing friends and colleagues moving out of these large cities for a variety of different reasons.
Yeah.
And so I'm curious your thoughts on this.
Well, there's no question that's there are going to be secondary, tertiary cities that are going to benefit. You know, in Bend, Oregon, I was actually up there not long ago, just in the last few months. We bought a company in the family office near there. That will, I think, be a beneficiary. But would it be, if you put it on a comparative basis to a similar size city near a larger metropolis in a tax-friendly state, I would bet on the tax-friendly state, business-friendly state, low regulation state. So I think, you know, that's where we spend a lot of time focusing. It's really interesting. You look at the state of Texas, and I've talked to Richard Fisher about this many times. It has a higher credit rating than the United States government. It's amazing. So you think about our ability to fund infrastructure and education. We have that ability. These states that, and I don't off the top of my head know the state of Oregon's finances, but if you look at California and Illinois and many of these states where you have the flight of people and companies from, it's ugly. The state finances are ugly. And so their ability to get out of this predicament is, they don't have a lot of options.
Yeah, well, I don't quite know how Oregon finances its government as well, because there's no sales tax. Property taxes have a cap, and so they're very low. There is high income tax, but as someone who's an outsider and doesn't spend 6 months there, it's a perfect tax climate for me. But I see with people working remotely and much more comfortable, despite the fact that I agree with both of you that people are coming back to the office and will come back to the office. Either, it doesn't take much to move the needle in these kind of secondary and tertiary cities or suburban areas.
Yeah, one that we've done very well with is Boulder, Colorado.
Yeah. Well, I went to school in Boulder, and Bend is Boulder if you turn back the clock 20 years ago or 30 years ago.
Yeah, that's well put.
High barriers to entry too, right? In a market like Boulder. Great dialogue. Well, I think we maybe have time for one more. Amanda Brock, are you with us? Solaris Midstream, are you with us, Amanda?
I am. Actually, many of my questions have been answered, but the one thing, touching on what you said about live, work, play, Robert, and then touching, John, on what you talked about with this immigration and Texas being sort of ground zero on a lot of this, and then talking about these residential trends, it seems to be on a bit of a collision course for urban blight. We've got people really can't think about live, work, and play. They just want to be able to live somewhere they can afford, and those who can afford to live are heading to these outlying communities or out into the suburbs, because we're fundamentally rethinking how we are living our lives when it comes to our residential and multifamily choices. We may not want the high rises anymore. We may want something that's a little more individual. But how do you guys just sort of think forward with the overlay of population growth, with these choices that we are making, personal choices, which are economically driven, to what happens with the existing infrastructure and sort of the city center and potential urban blight?
Well, I'll take a stab at it. I think those are outstanding questions, and I certainly don't have an answer for them. But I will say that I think I think the pandemic has really has been an eye opener in many ways, and it's probably been a catalyst to quite a bit of new thinking that'll push the envelope and so forth. When you look at just the sheer investment in infrastructure that we've put into our major cities, whether it's you look at San Francisco, Chicago, New York, and you're looking at the mass transit systems and so forth and so on. I can't imagine a scenario where these things kind of go out of style. In other words, I think that people want to conglomerate. They want amenitization. I do believe in the live, work, play. I personally do not think that you're going to see a stagnation of larger cities. Now, I would tend to worry a little bit more about some of the things that may be a little more lasting than, presuming when in my personal view is that I feel like the amount of dollars that have been put into medical technology through this pandemic system is going to make us even stronger and more resilient than we ever could have dreamed, 10 years earlier, probably. So I feel like, John mentioned it earlier, people tend to bounce back. There's probably some over-exaggeration reaction. So I tend to think that those things will continue to come back and thrive. I would be a little more concerned about some of the industries that the international cities that are dependent on international travel and so forth. It could be some time before we get back to the same level of travel and that we've had before. And some of the patterns may change, but I don't see that as something that's sort of like an endemic issue going forward. But I mean personally, but I do think you will see it accelerate some of the trending. Like I mentioned at the outset, I think you're exactly right when you mention the need for affordable housing. It's the elephant in the room. And I mean, we're going to have a solution for that. And I think we're seeing the pandemic accelerate some of the concern and some of the trends in that direction.
Yeah, and just to personalize it here in our great state of Texas, we've really got some serious issues to address on this front. And Tom Luce is doing a great job of creating a plan that I think many on the call have even helped fund, looking forward, I think, to 2036. And how do we take the state and be prepared for this huge onslaught of people and companies? And how are we going to accommodate all this? A big thing we haven't mentioned is just investment in education. We sorely need that in the state. And that's between infrastructure and education. Education tops my list as our single biggest need in this state to just completely overhaul is the public education system.
I would agree.
More great answers, information, and yes, at this point, maybe we'll go to a couple of maybe alumni questions. Is Jason Signer, are you on the line with us?
Yeah, Jason's both an alum and a director and a former chairman. So, and
well,
Jason,
thank you for both Robert and John being here. I really appreciate that. I mean, the problem with COVID is it was a coin toss. You're either on one side or the other. It's either winners or losers, and nobody knew what was going to happen beforehand. Early on, the FDIC came out with a ruling kind of in March to make it easier for banks to forbear loans till the end of October. And I know a lot of borrowers at forbearance agreements up until now. Two-part question. Are you hearing banks extending that forbearance out further for those impacted, like hospitality or senior living or other groups? And then second is, if you had distressed borrowers that are forced to sell before the pandemic is over, because unfortunately it's going a lot longer than we anticipated back in March, what investment types would you go seek out during this while you're in the middle of the pandemic and can't see how you go afterward?
John, you have a thought on that? I have a couple of thoughts on that, but
go for it. Go ahead and lead off.
Well, I would say this: yes to the answer of this of this sort of artificial or government or industry pressure on forbearance. I personally believe that the shoe's going to drop on this because you've had the Fannie Mae, Freddie Mac, whatever. You've had all of this sort of forbearance. You've got the banks have been encouraged to forbear and whatever. I'm hearing it's year end. A lot of this is year end, and even the insurance companies are moving in that same direction. But I think we're sort of kicking the can down the road. What you're not hearing the forgiveness of debt or interest. You're hearing a forbearance. And so we've all seen it before is this kind of lost rent and this kind of devaluation will come home to roost. So I think it's going to, I personally believe that in 21 and 22, you're going to see quite a bit of distress, and you're going to see a good bit of involuntary ownership. So I would tend to view that as right now, and you haven't seen as much of the downside, or you haven't seen the kind of foreclosures that you will see. John, what are your thoughts?
Well, I'll hit the product type side, but just very quickly, you know, the Fed action has been so profound and impactful in providing liquidity, whether it's to banks or the CMBS world, et cetera. It's really muted the opportunity to go buy things cheap. We've bought one big CMBS deal. I say big for us. That was 50 million in size. We bought it at 50 cents on the dollar. I think it pays off at par. So we have not, I thought early on we may drown in opportunities, but the Fed action has totally taken that opportunity away. Not totally, but probably 70% of it. Ultimately, there probably, as Robert says, I think more opportunity will come. In terms of product type, you know, we're really focused on anything wellness related, certainly any kind of housing opportunities where it's multifamily. We also bought a company that does manufactured housing, actually very, you know, I would say relatively high-end manufactured housing, does not look manufactured. Certainly distribution, Robert's the pro there. And then repurposing assets is a big opportunity, redevelopment of existing assets. So we're doing a fair amount of that, trying to tie up things that it can be totally repurposed. But you know, well located.
One thought, Jason, is that I think what we've always tried to do is just look at the fundamentals, because it's really hard to time these things out. And we're still on with the pandemic situation and where we've been with lack of transactions. It's so difficult to price anything out there. Finding, you know, price discovery is such a challenge right now. So, you know, we just look at but if you just look at the demand side and where you think the demand side, and that is usually a good bet. You know, and then I think you look at some of you talked about how do you look at distress opportunities. I would tend to, we kind of look at it from the standpoint of you know, you want to buy low and sell high. So if you look at, you're not going to go out today and in the industrial market and go make you know, and buy new industrial warehouses on the cheap, because look at the current cap rates and look at the demand side. So and then if you look at, let's say as an example, in the retail area, John just mentioned you were talking about we've got 5 times as much retail than we need. Lucy mentioned the malls. You've got this retail dilemma, which has been a mega trend of a problem and you've got online sales going up. So if you look at that overall situation, someone could say, well, you might be able to make a bargain in the retail area, but then what's the picture look like 5 years down the road? In other words, what do the fundamentals look like then? Whereas some areas may be more dramatically impacted by COVID, but they may be bouncing back. John's area is well located hotels, and that's pretty interesting because it was hit the hardest, and yet, you know, most of us feel like there's going to be a solid comeback there. So in those kinds of scenarios, you might find some of the better opportunities.
One word answer. What's your favorite? If you had to pick one, what's your one word answer? What would you pick, Robert and John?
For what?
For opportunity to buy. If you were going to buy today a distressed asset type, what's your favorite asset type to buy? One word answer.
Land.
That's a good one. I might say well located multifamily.
More good questions and answers. I think we're going to try and push on maybe one more question. We're running out of time, and maybe one of our scholars. We have a scholar from SMU this year, Jenkins Bender. Jenkins, are you on with us?
I am. Thank you so much for your time. So everyone is very bullish on industrial right now, as you both touched on. But my question is, do you fear the oversupply of industrial over the next decade or so? And if so, what does that tipping point look like?
You want me to take a run at that one, John?
Yep, go for it.
I think it's a great question because we've seen over all the years a quick, rapid response to demand by developers building product. And on the industrial side, as we know, you got the shortest cycle because there you can go out there and you can buy that land and put them up pretty fast. So that's also can work in your favor because when you have a real problem, you can stop. You can stop it. But I think I think that as strong as that demand is, it's just going to, a great question mark is going to be just how much supply we put on the market. You can put on enough where it's a real issue, but mega trend, I would say when I mentioned a minute ago, the fundamentals, if I look at the industrial side, I like the fundamentals there. And so I would feel like that even if you get to an overbuilding scenario there, you'll work your way through it. I worry about the situations where you have an overbuilding scenario and you don't have the demand drivers.
John, you want to add anything to that?
I think that covers it. Let's take another question.
Do y'all have time for one more? We're right at 12:59. You're good with that?
Good for me.
Okay, great. Justin Wood, he's our scholar out of North Texas. Justin, are you still on for your question?
Yeah, I am. Thank you guys so much for putting this together. You covered a lot of this too, and I work on the residential mortgage lending side. And I put it in the chat, but even with the drop in interest rates to record lows, small business owners are getting hit the hardest, especially with the more aggressive lending guidelines from, whether it's Fannie Mae, Freddie Mac, VA, FHA. So as it relates to your world, really in the commercial multifamily lending, what impact are you seeing to, small to mid-sized business owners, their lending guidelines, and when do we think it's ever going to recover, for people looking to, acquire multifamily commercial property from like an underwriting perspective? So I know there's a lot to unpack, but I'm just fascinated by that.
Well, let me understand. You're saying from a standpoint of financing acquisitions?
Correct. Yep. So as you look to acquire multifamily properties, who's buying that coupon?
Yeah. That's a great question. I'm probably not the right one to ask in that regard. There is as you may know, as I'm sure you know, there's an enormous amount of capital that we're over allocated with capital for real estate, and apartments, probably next to industrial is the most favored asset class, being viewed as, once again, strong fundamentals, great mega trend, and many of the investors under allocated. So you've got an enormous amount of capital earmarked for multifamily. Then the question becomes more of a pricing issue. I think as you're talking about how does a small investor come into that scenario, I would probably have to say for me it would be more of a guesstimate because I'm not exactly familiar with how that is working.
Thank you.
John, you
want to add anything to that, or?
Yeah, I would just say, I think if we have not found any issue whatsoever in financing our multifamily. Multifamily has been, of all the product types other than industrial, has stayed fairly liquid through this process. So we have both new developments and, existing acquisitions of already built projects that we have had no issues financing. I think, if you're somebody beginning in that space and you're trying to gain financing, then, that it may be more traditional bank financing that you have to go for. And, you try to start out small and build your way up. But I don't know if I addressed your question exactly.
No, that's exactly right. Thank you. Very encouraging.
Okay, I think I'm going to turn it back over to Meredith, but I just got to take a second to say how much I appreciate being involved in this. Listen to this conversation. has been terrific for me personally, for I think everybody on the call, the experience and the knowledge. That's why you guys are talking. Quite frankly, I wish we could go on for another hour or two today and that we could have this as a regular, call it fireside chat with you guys. But Meredith, I'll turn it over to you.
Okay, well, thanks, Curtis. You did a fantastic job. And Robert and John, cannot thank you enough. Two Titans, and the conversation was just so high level and unique. And that's what makes these events so special. For our participants, if you have any feedback on how we can make these events even better, don't hesitate to email me. I love constructive criticism. So thank you everyone for being on the call. And thank you Texas Capital for being our presenting sponsor. And I look forward to seeing everyone on our next call. Thank you again, everyone.
Well, thank you, Meredith, and Curtis, thank you. Great job.
Yeah, thank you. Thank you, both of you. And I really appreciate everybody dialing in. The Titans are on the other end of the line. So